Good evening, everyone. We are here yet again with a live session of on Facebook with one of our stalwarts in the industry, Mr. Aashish Somaya. Welcome, Aashish.
Thanks.
Ashish is the CEO and MD of Motilal Oswal Asset Management. He holds a Bachelor of Engineering in Polymer Science and Masters in Management Studies in Finance from NMIMS. He passed out of MMS Finance at NMIMS in the year 2000. And Ashish is responsible for strategizing, growing, and managing the operations of Motilal Oswal AMC, which is an expert equity boutique based on its time-tested buy right, sit tight investing style. And it's imperative to mention when we talk of Motilal, we have to mention that it's one of its kind AMC in this country, which is an equity-only AMC. Basically, they started with almost like 1,300 crores in 2013 and are now at 38,000 crores of assets which they manage at the AMC. Aashish has over 19 years of experience in business strategy and management, process-driven sales and distribution, and I've known Aashish for a very, very long while in this industry. So this promises to be a great interactive session. Aashish is obviously privy to both sides, to the consumer side, the customer side, and the pain points out there, and obviously towards the fund management side and what new strategies are fund houses adopting and what are the fund managers thinking in this environment. And as we launch into this, it's very critical for me to say that these are not the greatest of times when we are talking, Aashish. I think it's been one bloody July, if I can, for lack of better words. It's a total mayhem on the markets. And one thing which kind of perplexes everyone. It was all good. India's story was shining. It was all rosy. We had great growth story going on. Suddenly in the month of July, there comes a budget and the market is all shattering down to pieces. It can't be only budget, right? There has to be more to this maddening correction market.
Yeah, I mean, so sometimes it's very, very difficult to pinpoint what exactly has damaged the sentiment. And I can tell you with reasonable confidence that whatever is happening right now, well, of course, some of it will be grounded in fundamentals and some of it will be grounded in reality. But my sense is that sentiment is weighing more than the fundamentals or the reality right now.
Mm-hmm.
And let me elaborate.
Yeah.
The last time you said, like July was a bad month. The last time we had a real bad month was when this financial institution that is ILFS, they kind of, they defaulted and that's where the thing started. So in September, I remember that the small cap index declined 15% in the month of September 2018. By the way, July decline is less than that. Nothing great, but yeah, it's less than that for the sake of records. But you know what? When ILFS defaulted, that was also accompanied with a lot of mess on the international side. So our rupee was heading towards 74, 75. Oil was $88. Mm-hmm. We thought that the US will have more rate hikes. We did not know at least that they are around the corner with a cut. Our own RBI was in a calibrated tightening mode and we were raising rates actually. And we were consistently warning that inflation will go up. And more importantly, in September last year, we thought that there could be a hung parliament or there could be a weak coalition or something like that.
Perfect.
So this is where we were in September 2018 and look where we are now. We have a clear majority government.
Right.
Oil is not 88. It's definitely not heading to 120. The rupee is not 74 and 85 and where it was feared to be, it's 68, 69 range. Many things have changed. RBI is cutting rates. The US is talking about cutting rates. It gives us tremendous elbow room.
Absolutely.
So if you barely talk, and banks are not making the kind of losses that they were making last year, things are improving on that front also. And last 3 to 4 years, no earnings growth. At least FY19 ended with some earnings growth. There was at least an uptick.
Right.
So really, if you ask me, I don't believe all of this is grounded only in fundamentals. Mm-hmm. Some of it is sentiment. And I can also pinpoint where the sentiment got worse off. I think people had no expectation from the budget, but still few negatives came out of it. I think that hit the sentiment. The other thing which is hitting sentiment is because you are seeing auto. Auto is the biggest sector in the industry.
Right.
And it is going through its own set of challenges, because in auto, for example, in between fuel prices were high. Borrowing from NBFCs was difficult. So the insurance related changes, preparation for BS6 coming next year.
Right.
Many things happened in the auto sector, whereby that, I think that, every morning we are reading in the newspaper that autos are slowing down. I think it is regulation and NBFC, everything put together. I think it's a transitory phase.
Perfect.
But yeah, I've given you a long answer, but I would say that a lot of it is sentiment. whereas actually the fundamentals have improved.
So I think we broadly agree on that part, that September the story seemed much worse than what it looks like today in terms of fundamentals. But so much has gone wrong with the sentiment, and again, it can't be like, I agree again on the auto part of it, and budget may be going wrong on few parts, but if we have to like really figure out, is the growth at the ground level really slowing down so much as is the brouhaha in the entire ecosystem, or we're making a lot of noise just because obviously the budget couldn't touch those chords which it was supposed to touch? Are you seeing the growth part really slowing down?
But you know what? Every time somebody says that the growth is slowing down, I'm really trying to think what examples do they quote to tell me that growth is slowing down. And every time somebody wants to tell me that growth is slowing down, boom firke they tell me about auto.
Absolutely.
Right? And I explained to you at least 5 reasons why auto is in trouble.
Perfect.
And a lot of them are self-inflicted, right? I mean, if we decide that we are moving to BS6, if we decide that, okay, at some point in time, we want to move to EVs, if we increase the insurance costs, on top of it, NBFCs are not willing to lend, so credit availability is difficult. So there are multiple reasons why at least a good part of the component, which is auto, is reflecting. But if you tell me that our air conditioners not being sold, or our white goods not being sold, or how are the core consumer companies doing, I think there is a mixed picture. But I think predominantly this massive, historic level of slowdown in auto. And mind you, auto is not a small sector. It is 7% of GDP, and it is nearly half of our manufacturing GDP actually. So my sense is that look at it the other way around. I'm not privy to any. I'm as informed or misinformed as all of our friends here are. But what if they actually cut GST on auto? Right? It's at 28%. It is 7% of GDP and half of our manufacturing GDP. And some wise guys, if they think, okay, look, I think this is causing a lot of pain. And, while we should promote EVs, but right now for the auto sector, we should cut GST, or we should come up with some kind of packages. I think the sentiment will change.
Perfect. So, okay. So auto, I take your point.
It's a large part of the painful discussion.
Absolutely. Are there, so if I were to twist this entire thing, are there any safe zones in the economy right now? Any safe bets, any safe sectors, which from an AMC's perspective, you guys have found out, or how are you placing your bets now?
No, see, I mean, to be honest, nothing is safe. I'll give you examples. I'll tell you the reason why. Till last year, financial services was supposed to be a safe haven, right? But some of the perceivedly the best institutions, may it be NBFC, may it be banks, you find that some of them were actually in trouble, right? Because when liquidity becomes bad and when credit becomes a matter, the trust gets broken for some reasons, then you see where the issues are or the fault lines are. So I would have said that yes, banking and financial services is a favorite sector for us. It has always been overweight for us, and we were fortunate that last year we didn't meet with any accidents on the BFSI space at all, right? But if you ask me, in the new areas, I'm very gung-ho about, say, for example, insurance as a sector. Okay, it is something which people don't focus enough on, but I think it has a great runway. And to even imagine that for a country of our size, the first insurance company got listed less than maybe, I think, 18 months back or something. And for that matter, why I always talk about BFSI is also because, you imagine for a country of our size, we're living in a country where banks are coming with IPOs. I mean, you go back and figure out when was the last time a bank or an insurance company came for an IPO in the US. It must be decades back. Absolutely. So, stuff like insurance, banking, and I think, let's say, for example, even other sectors like, say white goods. I mean, markets go through their phases of overvaluation, undervaluation, bullishness and bearishness. But intrinsically, what is there? I mean, you are just around the corner with a phase where the best of companies are going cheap. There has been massive destruction in the last 1.5 years. And whatever you thought was not gettable a year back, some of those things are getting interesting.
Perfect. So that's more, let's say, a sectoral positioning, basically. So if I were to just again elaborate this question and ask you in terms of, let's say, the market capitalization perspective,
Yeah.
are you finding more opportunities now in the mid cap or the small cap zone, or do you still think that large cap being a safer zone, that's where the investor should be? And so what are your takes on that?
No, so I am an eternal fan or optimist on mid caps. And I will not go by the regulator definition, because for the audience to know, we all know that, say for example, the regulator defines the top 100 companies are large cap.
Right.
Stock number 101 to 250 is mid cap,
Absolutely.
and 251 onwards is small
500
cap, micro
small
cap,
cap,
whatever you might call it. And just for the understanding, stock number 250 is roughly around 8,800 crores or 85, basically 8,500 to 9,000. So that's over $1 billion. Correct. It's just over a billion, 1.2 billion. Now, I don't get into the regulator definition, but all our products that we invest in, we have good amount of concentration in the range of $500,000 or 1 billion, right up to about 4 billion.
Okay.
So I'm talking about companies which are, say, 3 to 4,000 market cap, right up to 30,000 crore market cap. I think that's the space, without getting into definitions of small, I think that's the space where I think historically we've always made money. Because in our country, the biggest of brands fall in this market cap. Which, the biggest footwear maker and the biggest luggage maker and some of the private sector banks and some of the insurance companies and the asset management companies, the best domestic pharma companies. The best of companies in India are actually in this $2-3 billion, 1 billion, 4 billion, that kind of market cap. So if you're an investor, who can digest this volatility, if you're okay, let's say last 2 years in mid cap, maybe people have made no return.
Absolutely, maybe negative.
Maybe negative in small cap. If you are somebody who is mature enough and who really has the gumption to understand that I will invest for 5 years plus, and in that there'll be a couple of years where I'll be underwater. Look, honestly, everybody, on Facebook or on the social media, everybody flashes to each other that, be greedy when others are fearful and be fearful when others are greedy. I mean, this is all just being forwarded here and there, and it's all being liked and shared. But when it comes to actually executing, who's executing, right? I mean, right now, everybody is talking about bad news. But they're not realizing what they were forwarding to each other when the markets were going to go.
So that's a good one, and I'm going to tag you with that statement on social media. But yeah, so for all those who have joined us late, this is a live Facebook session with Aashish Somaya of Motilal Oswal AMC. We at Moneyfront obviously try and get you the expert views on what is currently happening in the market. And what Aashish is saying is actually quite applicable in today's scenario. We all like to tag each other and quote on social media from those great Warren Buffett quotes or from Ben Graham quotes and so on and so forth, saying that when everyone is fearful, be greedy, and when everyone's greedy, be fearful. And here's a time and scenario in market when everyone is actually quite fearful. The sentiments have actually turned bad for last 1 month or so. And yet we see no signs of greed coming from those educated investors, and that's where
at some level, when the markets are bullish, we all feel really great, and when the market is bad, when it's time to really show your conviction, at that time people kind of pull back. I mean, frankly speaking, all of us are investors, but at some level, it is intellectually dishonest, right? I mean, this is the time to practice what you've been quoting all along, right?
Absolutely.
People saying to each other that, in 1980, if you bought 10,000 rupees of Wipro, then in 30, 40 years, it would be some few hundred crores. Absolutely. What is the point in forwarding all this if you're never going to implement?
Perfect. So I think it's some bit of intellectual stimulation from Aashish, and also one important point which he alluded to, which got lost in this conversation, is that he's an eternal bull on mid cap and small cap segment, provided you can take it in your portfolios, basically, and have that patience of 3-5 years, because obviously last 2 years haven't been very kind on that that segment. But otherwise, you're saying this is perhaps tending towards a time when one can move towards mid and small cap pockets, right?
Yeah, because see, because when the when the night is darkest, or when it's the darkest point in the tunnel, is when you right. The other thing is that nowadays you read a lot of news which is very, very negative. I just want to tell you that the news comes in the newspaper after it has happened.
Yeah.
Right. So when do you read a lot of negative news? After it has happened. Absolutely. You don't read a lot of negative news when it's going to actually So the positive will also come after it happens.
Absolutely.
That's the thing to keep in mind.
Got to catch it before.
Yeah.
So perfect. We get you. Aashish, so let's get back to some market thing. When do you think that actual earnings rebound is likely to happen? And just to give you a perspective, I've been doing this Facebook live session for last
Sure.
3 years since the time Moneyfront has we've started with this brand. And every quarter, when we go and meet with fund managers and speak to them, and every time I get an answer that next quarter is the quarter when we are heading towards a double growth. But so far, to be very honest, it's eluded us, and the numbers are just not showing up. So when do you see that turnaround likely to happen?
Yeah, so what is, you're right, because it is frustrating in that sense. And, I've even seen memes like, mere Karan Arjun aayenge, as if, earnings aayenge, those kind of things. I've seen it in the past. I don't know who put it out, but I've seen it. But, the thing to keep in mind is that a lot of this is a bit statistical also. It's not just fundamental. Why I'm saying statistical is because, for instance, we were speaking about banks. And we know that because of some legacy non-performing asset related problems, the Reserve Bank of India instituted like an asset quality review in 2015.
Right.
And then it was not for the banks or their auditors to interpret what is NPA. In some sense, the Reserve Bank started dictating that, okay, this is not working. This is all, so there was some remediation for NPAs and accelerated provisioning, which was done, etc. So if you see pre-provisioning, a lot of banks may be making healthy numbers, but because of provisions for the past NPAs, their profits are getting suppressed continuously. Right. Now we are in a space where bulk of the NPA recognition is done. Net NPAs are actually starting to come down, and incrementally the accretion to NPAs is either not there or it is slowed down quite a bit. So that's why I said it is statistical, some of it. So you will see that in FY20, now this is not about probability. You will see that the things are better than what it was in FY19 or FY18. You already started seeing some of this impact. The other is, in the index, if you see last year, for example, Tata Motors had this outlier kind of 27,000 crore kind of loss because they wrote down the goodwill of GLR. So some of these things can, suppress the numbers.
Perfect.
But I think that when you talk about earnings, it's more about stock picking. If I have to build my portfolio, I have to buy companies which I think will actually produce the results.
Right.
And irrespective of the performance, I can assure you that for our portfolios across FY19, I think the delivered EPS growth will be between 15 to 20%. So it depends what you pick in the portfolio.
Perfect.
If you are a guy who is contrarian or deep value, and if you think that you are going to buy companies which are loss making or which are turnaround, and then you're hoping for them to bounce back, that's a different way of investing. Right. People like us, we are looking for more steady state kind of thing, right? So there could be leads and lags in performance, but basically we are looking to buy profitable companies. So in our portfolios, the EPS growth pretty much has been in the range of 15 to 20%. So I would like to say it's more a matter of what you buy and what time frame you're looking at.
So you're saying there are pockets and there are segments where the growth is happening. It's just about that market perhaps catches it with a lead or a lag, and it depends on more market scenarios and everything. So for all those who are watching us live, we are in a live conversation with Aashish Somaya of Motilal Oswal AMC, and at Moneyfront, you can post your questions to us on the Facebook live page of ours if you have any, and we will definitely take it up to Aashish. So continuing this entire sequence, we are now in a rate reduction scenario, and not just in India, but it looks like it's a global phenomena. So we will have our monetary policy meet very soon, and the Fed is about to meet. And there is a rate cut likely, which wasn't the scenario, as you said, around September. Yeah. How do you think this was going to impact the markets now?
Look, there are two things. One is, given where our economy is and given where our inflation scenario is widely believed that, we deserve to have lower interest rates. And this has been spoken about for nearly the last couple of years.
Right.
But, if you were following the policy a year back, 2 years back, in fact, in 2017, there were rate cuts in India, a couple of rate cuts in India. But then the commentary became that if the US is raising rates, how can we keep cutting rates? Because it reduces our differential between the currencies vis-a-vis the inflation rate and stuff. And if US is raising rates and we cut rates and the differential comes down, then we'll have outflows of capital and the rupee will depreciate and so many fears. So long story short is that we felt the need for rate cuts, but we've been saying that if US is raising rates, we can't cut rates. And I know a lot of enthusiastic people who used to be awake at 2 in the morning and they were watching the US policy. And the US said, yeah, well, we think that we should be raising rates. We should be raising rates, but the economy is slowing down and China is devaluing. So if China is slowing down, how can we raise rates? So this whole macro thing is one never-ending vicious or virtuous cycle. And that's why beyond the point, we don't focus so much on macros. But yeah, the limited point is that yes, now the US softening stance gives us a lot of elbow room. So I'm pretty sure that, so one element is cutting rates, which I think we will see. The other element is that even if the rates are cut, will the banks be willing to lend at a lower rate? Because it has to pass on. And I think with the banks' balance sheets getting repaired and the NBFC crisis kind of receding in the background, I'm quite hopeful that now the actual on-ground interest rate should.
That's
and
so
instead
far
of borrowing locally
in the country, actually.
Yeah, so there has been RBI has definitely put in efforts to reduce rates, and they have put efforts to improve the liquidity in the system. Now the banking system is in huge excess surplus liquidity.
Right.
But I think the whole NBFC related matter, which was related to ILFS and a couple of other companies, I think that put paid to the efforts. Delayed the transmission. But I think now, and plus, the government is talking about borrowing abroad, so that kind of eases the pressure a little bit as well. So in the next 3 to 6 months, one can be reasonably confident that rates will actually head down. And I'm not talking about the 10-year bond. I'm talking about the rates which businessmen
transmission of rates possibly is likely to happen. Is what you're saying. Okay. So we broadly get that, Aashish. Before we have roughly around 7 to 10 odd minutes before we wind up this session. So any tips for investors who are watching this session? Anything from your end? What should they currently do? It's extremely volatile. Should they enter in? Should they dabble into equities? Should they just stay away?
So let's look at it this way. Like in Hindi, they say "sawal ka jawab sawal nahi hota," but I'll still take that liberty with you. Yeah. So let's say we are questioning that what should you do now? Mm-hmm. So let me ask you, what do you think one should have done in August 2013? Or what should have one done in, say, September 2008? Or what should have one done in, say, May 2006? So, I read it somewhere, and investment advisor friend of mine, he posted it somewhere. I read it that every past correction looks like a missed opportunity.
Absolutely.
Except this one. This one looks like a fearful. The current correction looks like a nightmare, but all previous corrections look like missed opportunities. So it's very, very difficult. I mean, it's easy for me to speak and difficult for our viewers to implement this. But, unfortunately, the hard reality is that you only get rewarded for venturing out when the things are iffy. If everything was perfect, then you would not be seeing this. Yes. So you don't get rewarded for buying when everything is perfect. You get rewarded, for example, when you buy into underperformances, when you will actually experience the outperformance. If everything was hunky-dory, then, why would you get the prices that you're getting?
But anything which can change the sentiment or the overall outlook currently, what do you think can be a trigger point for this one?
Look, sentiment is something which is very difficult to forecast. Just like we were talking in the beginning, in the last couple of months, I narrated a whole sequence of fundamentals which I could have cited as examples that there is improvement, but we're not able to exactly pinpoint what damaged the sentiment. The same way, I don't think you'll be able to pinpoint what will actually suddenly change the sentiment. So instead of waiting for sentiment to improve, it is best to act when everybody else is quite despondent and disinterested. But what can change? For example, if the government finally decides that, okay, look, we need to intervene. And I give you one example, which is frankly just my speculation. I don't know if this is the way things work. But, like we discussed, interest rate transmission, like a big rate cut from the Reserve Bank or a change to some GST related policies, or, actually the implementation of foreign borrowing. So anything can actually anything can actually change the sentiment.
Understood. I'll take this liberty with you. I wouldn't have otherwise. But if you were to change 2 or 3 things in this budget, or to fix the sentiment? What are those 2
Yeah.
or 3 trigger points which government can perhaps do?
See, look, I have been a stock market guy for 20 years. So whatever I say, take it with a pinch of salt. But since you're asking me or putting me in that place, I genuinely, hand on heart, I think that our equity taxation is completely out of whack.
Yep.
And I'll explain to you the reason. Look, companies make profits. They, of course, pay tax on their profits.
Mhm.
After the tax, so it's tax paid income.
Right.
Now you are a shareholder of the company. The profits which the company makes, it's your, aapka hak hai na, it's
Right.
your money.
Absolutely.
So the tax paid profit is what the company is trying to pass on to you as a shareholder.
Mhm.
But no, on the tax paid profit, they have to again pay a dividend distribution tax before it reaches your pocket.
Perfect.
Now, if you've been a long-term equity investor, then it's not surprising that you get, say, more than 10 lakh rupees as.
If you have that, then again there is a.
Matlab, if you're a successful investor for a few years, then 10 lakhs income is not unreasonable, right?
Right.
So when the dividend hits your pocket, you again pay tax on it. So on the income, you have paid, say, 35%. So you are roughly from 100 rupees. I think, I mean, we'll not get into accurate numbers, but it's from 55% or 56%
Absolutely.
tax is there. That is one. Now, how do you access the equity? You will buy on the exchange. There is a securities transaction tax.
Perfect.
How will you exit it? You will sell. There is capital gains tax. Now, look at the further exaggeration which has spoiled the sentiment. Now, I am a businessman. I feel that I have excess equity in my company. My return on equity is suffering. And for the business that I'm doing, the capital which I have is adequate. So I would like to reduce the equity.
Yeah.
I don't want, 20 years back, I started the business. I invited external capital that served the purpose. Now I would like to reduce the capital base. No, you cannot return the money. So what should I do with the money? Just keep.
Absolutely.
Right. And then there are statements that you reinvest. So I should reinvest in unrelated businesses. Then you will question me on corporate governance. So if genuinely, I think, forget, even if I was not in the equity market, if I was a complete outsider and if I read this sequence, I think anybody can say it's unfair and it's illogical.
Perfect. We have one question out there on the Facebook, and taxes on super rich. So though the viewer out there is asking, is that the reason behind the recent content? But what's your take on that?
No, look, I think that taxes on the super rich or tax on capital gains.
Yeah.
Look, the point is that these are all outcome based taxes.
Absolutely.
If you make a gain, you pay a tax. If you have that income, you will pay tax. But also keep in mind that, we are at 42.7% for the super rich. And then on an average, 18 to 20% GST.
Yeah.
So you earn money, you pay 42.7. And after that tax paid income, when you spend it, you pay 18 to 20. And you're talking super rich. So, hotel is 28% and cars are 28%. All those kinds of things, right?
Yeah.
So 20 plus. So how much tax are you actually paying is what you need to think. And then we are not living in the US.
Yeah, so
the other thing which I find objectionable in the commentary is that it is said that in our country, rich people need to sacrifice. Now that's a misplaced statement. I'll tell you why. Because we are not living in Europe. In our country, who are the rich people? We don't have. Everybody is not from a rich family who got an inheritance, right? So in our country, the rich are also actually, most of them are first generation. They would have been lower middle class people 15 years back.
Absolutely.
So I think the commentary is what is hurting. I don't think paying taxes is hurting.
Very interesting. So I think that's the whole take. It's just about the overall sentiment which has gone drawn with the words perhaps being spoken or the manner in which they have been laid out. In
what is our public policy? What is our ethos? I think it's more about the statements which are being made. I don't think it's about paying a bit more tax.
On a somber note, somewhere is there a feeling creeping in that the regime is turning very, very pro-socialist, or we are as an economy we are moving more left than we should have, or being in the center, we are just it's more a political kind of a question, but I think we can end on that note.
But I'll tell you something very funny. There was a West Indian cricketer, I don't know, somebody said that Anil Kumble was an extremely successful spinner because he was actually not a spinner. So, so that's where this whole right and left and all these things matters. But I really think that, we all voted for this. The majority of the country voted for this government. So everything is not wrong. Perfect. There are many things about them which are great, which are really like the execution, going after corruption. So all these things are absolutely fabulous. And like I said, it's not the number 42. But when you say that, but when you there is certain commentary and implementation, which is what I think makes people think negatively.
Perfect.
But on your question of going left, look, it's a matter of situation. In a country like ours, we say that we have a demographic dividend, but just look at it this way: that if bulk of this country, they don't have running water, they don't have gas, they don't have electricity, they don't have roads, they don't have hygiene, they don't have medical services,
Perfect.
they don't have education. How are they going to participate in the economy? How will you ever realize your demographic dividend if most of the people have to really think that when I wake up in the morning, how will I reach my office and will I have electricity or not, right? So I think a lot of things they're doing are fabulous. They are needed. Otherwise, how will these people participate? And people who are whose duty it is to pay tax, they should pay tax without grudging. There's no doubt about it. I think it's just the implementation and the prioritization. Look, you need to do both. You can't be just one way.
Agree. So I think the whole takeout there is we've completely run out of time. We have some 2-3 questions. Maybe we can separately send it across to Aashish for the
we can reply.
And we can reply to all our viewers. But the whole takeout here is it's more about sentiment. So there are a lot of things which are going right in the country right now. Even in terms of earnings, there has been a pickup. There are things which look positive, basically, and there has been a lot of social sector improvement, perhaps which is quite visible and evident. However, in terms of prioritization, there is an imminent need to prioritize few things and fix few things in the economy, which perhaps the government has to look into. And its sentiment and its momentum, like in games as in economy, it can change anytime, basically, right? So nothing so woefully wrong also, as Aashish was saying.
And make the most out of it.
Absolutely. So we end with that quote again: be fearful when the markets are greedy and be greedy when the markets are fearful.
Yeah, I mean, that's the quote which Mohit said, but don't just keep forwarding to each other. Dwell on it and implement also.
Perfect. Time for implementation, guys. Thank you very much for joining on this FB live session. Thanks, Aashish.
Thank you.
मनी फ्रंट के रेगुलर नोटिफिकेशंस के लिए बेल आइकन को सब्सक्राइब करिए या फिर हमारे इस चैनल को सब्सक्राइब करिए. धन्यवाद.